Hi, and welcome to Brett's Corner, where we cover everything small business. From how to start a business, to how to grow your business, to how to keep your books, and ultimately how to position and sell your business, and some things to think about after you've sold your business. If you're a small business owner, or you're thinking of being a small business owner, you're in the right place. My name is Brett Husselball, and I've been a small business owner for over half my career. I started my first small business in 1995. I quickly grew that one to over multi-millions in revenue, and I sold that to a Fortune 500 in 1998. I started my second small business in 2000. I grew that one more slowly to over $1 million in revenue, and I sold that to a multi-billion-dollar corporation in 2014. And now I'm retired. And what I like to do here at the Corner is to share the benefit of my experience with you. So, before we begin, a quick disclaimer. Number one, I'm not an attorney. I will share with you some of the experiences I've had regarding legal issues and what worked for me, but what worked for me may not work for you. If you have specific legal questions, consult an attorney. Number two, I'm not a CPA, nor am I a certified financial planner. But like every business owner, I know my financials, and we'll talk financials, and I'll share with you some of the things that you should know. But if you have specific financial questions or tax questions, consult a professional. Same goes with investment questions. Consult a professional. So, with that out of the way, let's get on to today's video. Hi, today we're going to talk about some financial terms. And unless you're a CPA, you may not be familiar with some of these terms. But as a small business owner, you need to know them. Today I'm going to cover a list, partial list, of some of the terms that I think every business owner should know. We're going to start with net margin. Net margin is basically the profitability of your business. It's all in. It's all of your revenue minus all of your expenses over a given period of time, usually on an annual basis. Includes your taxes, also includes any interest you make at a bank. So it's all in. Now, net margin is different for different types of business. And I would encourage you to understand what a healthy net margin is for your business. Go Google it. For my business that I own, my first business, a healthy net margin for a service business at that time was around 10%. We usually came in around 8 to 9%, so I felt we're doing fine. That was my benchmark, shooting for that 10%. Know what yours should be. It is a benchmark. It's a way of measuring whether you're healthy, whether you're doing well, or whether you need to do some things differently. So know your net margin, but it's usually calculated once a year. Operating margin. Your operating margin is almost all of your expenses. It's all of your revenue over a period of time minus almost all of your expenses. It's basically all of your direct expenses, all of your indirect expenses. It doesn't include some of your taxes that you pay, usually the ones you pay on an annual basis. And it doesn't include usually the interest that you earn at a bank. So that's the difference. Net margin and operating margin are usually very close, and you can watch operating margin on a monthly basis. There's a report in just about any accounting package called an income report or a profit and loss statement. You can print that out for a given period of time on a quarterly basis, and you can see what your operating margin is. And that's going to be a leading indicator of what your net margin will be. So it's a good thing to watch. I always watch my profit and loss statement. I watch what my operating margin is. Margin is always measured as a percentage. So 10%, whatever, margin is always measured as a percentage. So next, let's talk about your gross margin. But before we do, I want to talk about a concept that underlies that, your unit of sale. I've been working with small business owners for over 20 years, and it always surprises me when they struggle when I ask them, what is your unit of sale? They have to think about it. You shouldn't have to think about it. Not only should you know what your unit of sale is, but everybody in your company should know what your unit of sale is. It should be part of your company vocabulary. I don't care what it is you do. If you're a manufacturer, your unit of sale is probably the unit you manufacture, or the various units you manufacture. Are you a consultant? Your unit of sale is probably an hour of your time. No matter what you do, it can be divided down into a unit of sale, and you need to know that. Now, why do you need to know that? Well, it's related to your gross margin. It's also easier to calculate and to count and for people to track, so they know what their targets are, and we'll talk more about that. What is your gross margin? Your gross margin is basically the money you make by delivering a single unit of sale. It is your money that you bring in So what you charge for that unit of sale minus your direct expenses. Now, your direct expenses are those expenses that you incur to directly deliver whatever that unit of sale was. If you deliver no units of sale, you have no direct expenses. So your direct expenses are directly related to delivering whatever it is you deliver. That's your gross margin. So why do you need to know your gross margin? Your gross margin is a leading indicator of both your operating and your net margins. Me personally, on my first business, our unit of sale was a node. We did large inventories for big corporations of computer equipment. And a node for us was a PC and up to 2 peripherals, printer and a monitor usually. That was a node. And so our gross margin on a node was 100%. Every node of inventory we did generated 100% gross margin. I needed to know that. Why? Because I needed to generate 100% gross margin on everything we sold in order to have hopes of hitting a 10% net margin, because I had a lot of back office costs I had to cover. I had indirect costs that I had to cover with that operating margin. So I instinctively knew, or actually through calculations and monitoring, I came to know that I needed to generate 100 points of margin, percentage points of margin, in order to generate the 10% net margin I was after. Now, why do I need to know that gross margin? Because you will have competition. And competition will put pressure on you to lower your price sometimes in order to get business. And you need to know how low it is you can go. And so by knowing what the relationship is between your gross margin that you know right at the point of sale and how that's going to translate to your net margin, which you won't know until the end of the year, is important, because that tells you how much you can drop your price and still stay in business. And it's very important when you're bidding. You might be on the phone with a customer who's asking for your best and final right then and there on the phone. You have to know how low you can go. So as a business owner, it's critically important, in my opinion, that you know your gross profit margin at all times. What you're trying to hit, what you need to hit in order to generate and stay in business and be profitable. So let's talk about break-even point. That's another important concept. Your break-even point is that point in terms of units of sale that you have to hit in order to break even. And break even, by that I mean cover both your direct costs and your indirect costs. And it's usually on a given time period, usually per month. So in a given month, you have to sell X number of units of sale just to break even. Anything after that is profit. So why do you need to know that? It's an analysis you should do, but you need to get down to, we need to deliver X units of sale this month in order to break even. And you need to know that because, okay, so in my case, I do that analysis. I know for this month, I need 20,000 nodes delivered in order to break even. So what do I want? I probably want 26,000, 25,000 actually delivered because I want to make some profit. But I also want to give my people reasonable goals to hit. So 25,000, let's say, I go to my delivery people. I say, you need to be staffed and ready to deliver and capable of delivering 25,000 nodes. So make sure you're ready to do that. I go to my sales staff and I triple that number, 75,000. Show me a pipeline that shows me 75,000 nodes of prospective business in that pipeline, because that's what I need in order to generate the 25,000 that will actually become business to us, because I knew I won 1 out of every 3 bids that we put out. And so by knowing those numbers, I knew realistically how to manage that business and the targets I needed to give my people. And it all started, and it all starts by knowing, 1, the gross profit margin that you need to create, and the units of sale. Now we're going to get a little deeper into the break-even point. And for that, let's go to the computer. So let's look at this graph on how to understand break-even point. So let's start with the black line. Well, first let's start with the axis. On the x-axis, that's units of sale, starting at 0 at the left and going upwards as you move to the right. On the y-axis, that's dollars. So let's talk about the black line. That's your revenue. That's how much money you make. You can see if you sell no units, you make no money. And as you go up in units of sale, your money goes up. So let's talk about the slope of that line. What is the slope of that line? Well, basically it's dollars per units of sale. That's your price. That's the price that you set. So how many dollars do you get for every unit of sale is your price. Who controls that? Do you control that? I would submit to you, not really. You might think you do, but largely your market is going to dictate that to you. You're going to have competition. They're going to put price pressure on you, and your customers, your prospective customers, already have an idea what they think is a reasonable cost or price they should pay. You have very little wiggle room on what price you can charge if you have an established market and you have competition. And so that slope of that line is pretty much dictated to you by your market. You can wiggle room, you have some wiggle room in that. You can, depends on how you do your marketing, whatever, you might be able to charge a little bit more than your competition, but you have less control over that than you do on your costs. The orange line is your fixed cost. That's what it costs you if you sell nothing. That's your rent, utilities, insurance you have to pay, your back office staff, just staying in business. If you sell nothing, if you sell everything, that's your fixed cost. So we start at that point because we have to incur that cost anyway, and we start adding to that our direct cost. The red line is the sum. It is our total cost. It's our fixed cost plus our variable cost. So we sell no units, we have no variable cost. Those are our direct costs. As we sell units, our variable cost goes up relative to the number of units we sell. So we move forward and we look for the intersection between the black line, which is the revenue that we're producing, total, and our total cost line, our fixed and direct variable costs. We move down from there onto the x-axis, and that is how many units of sale we need to sell that particular month in order to break even. And so I would also submit to you that you have more control over the cost, both your direct costs and your fixed costs, than you do over the price that you can charge. So your profit, the difference between your costs and what you can charge, is more controlled by you by the cost. So it behooves you to keep your costs down, but you have to do it in a smart way. You can't get your costs down by sacrificing quality or delivery speed. Those two things you cannot impact when you're reducing your costs. But the more clever you can be about reducing your costs, and we'll talk about that in other videos, the more profit you can create and the more market share you can capture as a result. But this is your break-even analysis, and this is something you should do on a periodic basis. Understand what you want to do is you want to get, in order to stay in business, I got to sell this many units. You need to get to that number. How many? Because that's what people can understand. They know, okay, I need to sell this many units. Trying to manage them in dollars is a lot harder than trying to manage them in actual physical, tangible things that they sell. And so get your costs down, or get your targets down to units of sale. So everything in your business should talk about units of sale. So let's recap. There are some important financial terms that you as a small business owner should know. In this video, we've covered unit of sale, which is something you should know instinctively, and everybody in your company should know. Your gross margin, another thing you should know instinctively. The difference between operating margin and net margin, and we also covered your break-even point, how to calculate your break-even point. The whole purpose of the break-even point is to understand how many units of sale that you need to produce, sell, and deliver in any given period of time in order for your company to break even. And so that's a much easier target to give people. They can get their mind around unit of sale more easily than they can get their mind around dollars, specific dollars they have to create or hit. So it behooves you to know your unit of sale and those various terms, and in another video we'll cover the rest of the terms that I think minimally a small business owner should know. If you like the content we're providing here, please follow us. And as always, if you have any questions, please direct those questions to info@brettscorner.com. I'll watch that email address and I'll respond to your emails. I won't respond to comments you leave on the video, so please use the email address if you have any questions or you want me to respond. And as always, thanks for watching.